this is my fifth go at this, and amazingly enough and surprisingly enough, Heather and I have it's not a pact, but it's a fact that we don't listen to each other's speeches or preparation in advance, because I think that gives a degree of spontaneity. And when Heather was talking about 5 opticians in Putney, where she lives, then I was thinking, what's the most proliferated shop in where I live, which is in Richmond? And it happens to be hairdressers, right? Because I think it's things that you can't do on the internet. And about 2 months ago, my wife went to very expensive hairdressers, and she forgot to take her credit card, right? And halfway through the process, which is quite a long process actually, she phoned me and she said, "Could you bring the credit card?" And I said, "Yeah, I can." So I walked into this, it was called John Frieda actually, a bit of an advert, hairdressers. And the guy behind the counter looked at me and said, "There's not much we can do here, I'm afraid." not much to work with. Okay, so when you get up and you look at this thing, it says 1 hour, 15 minutes and 40 seconds, and you think, Jesus, that's a long time. But this is a game of 3 halves, and what it is a little bit of introduction from me. And it's a very short, thankfully, introduction to our very, very good panel of people. A little bit about why we picked the people and the part of the theme that they hopefully can elaborate on during their speeches. Then each of the guests is going to have a few minutes, 6, 7, 8, 9 minutes, to talk about how the subject of growth, and specifically around the area of how do we get the 8 to 9% that currently invest growing, and also the quality of what we give to those people growing. And then it's your turn, right? So this only works if I can do that, I can ask questions, and I might, right? But this really is an interactive and participative section. So I'm kind of reliant on you for the last 20, 25 minutes to ask some questions, or to pick up on one of the points, or some of the points, and elaborate on them. So when we were thinking about this session, we thought, okay, growth, as Heather said in her introduction, when you think about growth, it is our ambition to try and help people understand and contribute towards the growth in the number of people who take financial advice, as well as the quality of it. So what we've tried to do in this panel is to bring people from substantial businesses together who have a different lens and whose business has a slightly different focus. And so I'll begin by introducing each of the panel members, and what I perceive, and hopefully they will reiterate it, is how their particular business thinks about growth from the basis that they've created within their businesses currently. Talk about scale. I was adding up, I'm not very good at adding up, but I was adding up the number of the assets that I think are held by the 5 panel people, right? The businesses that they run. And it's over £320 billion worth of business. And think about that number. That's a big number, right? And that's a big control. So these people are influential people who influence the lives of the 8%, hopefully growing, who do take advice. So where do I start? Let me start with Jerry. All right. So we asked Jerry to come along. Jerry is the chief exec, relatively new chief exec of True Potential, a business that everybody knows. All right. And there are 2 specific aspects that I think are interesting from the contribution that we will get from Jerry. First of all, TP are known as a hybrid advice business. Right? They've got a significant number of customers, 625,000. Good guess. And they provide hybrid advice to those, bringing both the advice and the advice tools together. But also, interestingly, Jerry comes from a background which is almost exclusively banking. Right? So he understands the metrics of growing businesses within the banking environment, and bringing those banking knowledge and skills to the TP environment. It will be interesting to see how Jerry sees them as transportable skills. Sitting next to Jerry is Stuart. Stuart runs the private office. For those of you who don't know the private office, it is a fantastically interesting business. So from my perspective, I admire a lot of what Stuart's done and is doing, because he builds his business differently. So 75% of your advisors come through the academy or the growth plan. 25% of the shares in the business are owned by a charity. The business is principally owned by the advisors themselves. And the use of technology and data in the business to generate the inquiries and the leads is as good as I have seen in the industry. So we'll learn from Stuart about how to build a business and run a business in a different way from most advisors. On my right-hand side is Stephen Bean. Most of you will know Stephen. Stephen is the CEO of a business very close to my heart, which is Quilter. You'll have seen the results. They are exceptional. And it is probably known as the best vertically integrated wealth management business with good quality asset management at its core. You don't forget, right? So Stephen will be able to talk to us about the different aspects of the business and how bringing together advice, platform, and shortly to become technology, and also the new wealth acquisition, now rebranded, for the D2C stuff. So a multifaceted business. Andrea, again, relatively new CEO at Brooks Mac, comes from a long career in financial services in senior positions, companies like Royal London, Aviva, Standard Life, yeah? Interesting perspective on growth, because those of you who follow the markets, which I'm sure is all of you, will have seen that they have acquired very significant businesses in Lyft, in Lucas Pettis, in CST, relatively recently. So it's that aggressive growth strategy that Andrea will focus on. And lastly but not least, Michael, who runs the only pure platform play on the panel. It will be interesting to hear Michael's views on why he has eschewed, whilst growing the business enormously and taking over from a very charismatic Andy, how he has grown the business and at the same time eschewed some of the things that other people have done, i.e. advice, i.e. buying businesses in the advice sector. So without further ado, can I ask the panel to occupy the seats? I didn't ask for like an order of events, so I'll pick on people in the way that they've chosen to sit. And Andrea particularly said, don't make me last, so I shall make you first.
Okay, I think I did say not first, but hey, let's go with it. Peter's assurance of we will make this interactive and wing it, we'll go with it. So listen, good morning all, lovely to see you all in such a fantastic venue. Brooks Macdonald, I'll try and bring, I think Heather stuck really to the theme, so I'll try and keep my points to that as well. So adapt and innovate, you're all doing it in all your businesses. So I'll tell you a little bit about what we're doing. We've got some of our clients in the room and some suppliers in platform businesses, which are young Michael is making sure that all of our financial planning business assets are well looked after. So listen, that point is we're all connected and can support each other. Because ultimately, I truly believe with the tailwinds that we've got in the industry and the clients and the support they need, we've got everything to go for if we can support each other through that. Brooks Macdonald, for those of you who know it, was set up 35 years ago by another charismatic individual called Chris Macdonald. We've also got Richard, who's still in the business today, and a fabulous CIO, and his investment philosophy lives in our processes today. But Chris set the business up because he wanted to do something different. And what did that really mean? At the time, 35 years ago, there were a lot of commission models. He wanted just really one thing, transparency for clients, and we've grown from there. And I think that, back to Heather's client point, that is at the heart of everything we do. We only sell through independent financial advice. And we are fully committed to that because we truly believe that that brings really good outcomes for clients, and we can testify to that through strong investment performance. So essentially, he moved the model to a fee model, and as we all know, across the industry, very large players in it have moved reasonably quickly after that model. We've come a long way since then in terms of adapting. I took the role 18 months ago, but we grew from that stage, listed at just 500 million on the market, which in today's age would probably not have happened, but I took the business to the main market. We're now 20 billion FUMA and have a laser focus on clients. Our ambition clearly is to be the best wealth manager in the UK. We've got 3 very simple objectives to be able to do that, and the first one is client service, and that means servicing IFAs across the UK. We did sell the international business because ultimately the UK has a vast opportunity for us, and we believe that's where we're best placed to thrive. The testament to client retention, if we do the right thing for clients, night follows day, 98% client retention from all our acquisitions, and I'm really, really proud of that. We worked very hard. You'll all have been through processes of integration, and they're not easy, through systems, etc., through process change, but the real test is that our people retained the clients and supported them through that. So innovation, the second theme then, the road ahead for us in this room and our business. Ultimately, we are very focused on the retirement market, having spent many, many years in insurance, far too many years to count now. I really have turned the business to think about the retirement perspective and that tailwind that's coming into the market, with 15% of us in the UK moving into retirement. Obviously, you can tell from the panel we're all a long way from that, but ultimately, we need to help our customers prepare for that. So AI for us, we had our half-year results, and some of us on the panel the exact day that the AI piece blew up. So the first point from every shareholder was, what are you doing in AI? So I won't bore you with my rehearsed speech on that, because ultimately I felt as if we were... what did someone said to me, is it experimental? Is it AI washing? No, ultimately it is absolutely the opposite, certainly I'm sure in your businesses and mine. These are real tools, and some suppliers in the room, changing our business operationally and making it better for the end client, making it better for our own people. And we've got a multitude of case studies across the business. But what has struck me about AI is I've lived through very many big tech stack strategy changes in IT, which took forever. And as the finance person in the room, usually I didn't ever see the return on them, frankly, but we're now, as the CEO, I leave my finance people to do their job, but ultimately AI is delivering outcomes day in, day out in terms of efficiency and return on capital, and that's really encouraging because 6 weeks turnarounds, you can see it beginning to end, and I think that's really exciting, and we can talk about how it will shape advice. That's, I'm sure, a debate that we will get to. But also partnerships, I would say how we will shape and innovate our partnerships. We work with at least 3 of those big names so we're helping keeping that ticket price down as well. But ultimately, we are not a technology business. We will outsource that to very capable firms and frankly, complementary capabilities to what we're delivering to our clients. Now, Peter did mention M&A. It is 18 months ago, I took on with the board selling the international business back to that core belief of the UK market. We have brought in some brilliant businesses, and I'm really, really pleased with how they're interacting with our clients. The thing I think that surprised me most is the feedback loop into what is core to Brooks. Core to Brooks is 35 years of investment management experience that outperforms the 1, 3, 5 and 10 years. So ultimately, that feedback loop and proposition and development will help us continue to innovate, and that's in part how we have developed the retirement income strategies, which is really giving our clients some confidence and security. Much back to the videos, we support them in the build-up and in retirement. So, Peter, in the end, I'd summarise by saying my job is really simple. It's making sure our business provides service to IFAs across the UK, but ultimately provides financial security, because that's what people want most. And the one thing I wish I could do would be change the news feeds in the UK market. I don't any advice on that. I would really appreciate it. I got a taxi here, I was saying to Michael, I felt quite depressed when I got out of the taxi because the man talked at me for no less than 20 minutes, raced through bank, and by the end of it, I thought, he's going to keep his cash under a mattress, and that's the opposite of what he wants to do. So I give him some very brief advice. I'm not a qualified advisor, so please don't shoot me. But I thought financial security is not keeping in a very big bank's very next to zero interest return. So, but ultimately, it demonstrates what we are to get beyond the 9%. We really need to appeal in a different way, because the fear of investing is sometimes harder to get past, but that is a trusted that's a trusted personal relationship that all of your teams, our teams, are trying to do day in, day out to close that gap.
Yeah, thank you, Andrea. Stuart?
Thank you, Andrea. I am very mindful, sat in a room, it feels a bit like a gladiatorial chamber, and also being introduced that my contribution to that very big number is definitely not very big. But look, I wouldn't hold myself up as an expert of innovation, but Heather very kindly asked me to share my experiences, so sort of that's where it is. But within the TPO, we've spent the last number of years very deliberately building a business designed from the bottom up to grow. And therefore, the architecture of the business is designed in such a way to hopefully support that organic growth. Our numbers are a bit ahead of Peter's, so I'm mindful we look after about 3.5 billion for clients at the moment. And if we remove markets from that and withdrawals, we're growing at sort of mid-teens at the moment. And I'm mindful that will become increasingly harder as we grow with scale. But what I would say is, whilst it might be harder than a buy-to-build approach, it does compound, and we've definitely found that and managed to maintain that percentage to date. What we've done, though, in terms of growing our clients is not only build something that's not designed to inherit clients necessarily or to go out and acquire them, rather to attract an audience, and we're attracting lead inquiries, which are inbound at about 1,300 lead inquiries a month that we then convert. And we've taken the same approach with our people, and Peter sort of talked about our advisory team. We have, at the moment, 54 advisors across our 3 offices. Just over 75% have grown organically. We have just about 40% of those are female. Average age of our advisory team is 36, and we've got Roger who's retiring this year, so he drags that average up quite significantly, as you can imagine. So we don't look like, I'm very mindful of lots of the businesses around the business. In terms of how we hold ourselves up, it is as a financial planning chartered. It's the things that our team and we think our potential new clients really regard. I think in terms of equity ownership, so many of you will have seen in the press, we've just recently had a transaction with Goldman Sachs. It's their hybrid fund, so it's from Goldman Sachs Alternatives, so it's not their PE. Actually, very purposefully, they don't hold control, and they become our largest minority shareholder. Actually, it's not just the advisors who hold the equity. We've got a 25% shareholding with an environmental charity through one of our original founders. But every single member of staff holds equity in the business too, which I think not only drives that culture, but also helps us manage risk through the business also. So in terms of how we run our money, we're pretty vertically integrated, because at the core is that data. And part of the architecture that we've acquired is to be very vertically integrated. So one of the title sponsors with Hubwise, we have 86% of our assets with Hubwise, and our investments are run through Pacific Asset Management, and we've got about 77% of our investment assets held with PAM. That allows us to drive very rich data into the business, make real-time decisions, and work out where and how we spend our money. But it also allows consistency of approach, which marries against it. So I think lots of people, when I'm in much smaller groups than this, ordinarily say, Stuart, you're a fast-growing business. I would say we aren't just a business that grows. We're a business that is designed to grow. And it's a small nuance, but I think it's a very important one. But thanks. Pleased to be here.
Okay, Stuart, thank you. Steve.
I'll say a few things about my business and then just talk about the growth opportunity question. We're a vertically integrated business. We operate in two segments. We have an affluent business, and we also have a high net worth business in the discretionary management space. So similar to Andrea's business, which is called Achieveit in our space. We also operate, we operate in both the IFA market, and we have our own advisors. We've got about 1,500 advisors within Quilter, predominantly in a network. We also have a national business, and we've got a franchise called Quilter Partners, which we've established and are growing over time. I think one thing that people don't always know about Quilter is actually we are much larger on the IFA side, but 75% of our business actually comes from IFAs. It's a very important part and the fastest growing part of our business actually, which is hugely important. We have we have our own asset management solutions as well, and core investment solutions for clients. But probably we've got the largest MPS in the market, which we're very proud of. Our philosophy is really about helping customers. But we're an advised business, so we help customers through advisors. We really are about offering advisors a fantastic proposition, great service, great support, all of those things. And we mostly get it right. We think we've still got a lot of work to do. We think there's a huge amount of potential. I think the sector is a growing sector, wealth management. When you look at wealth management as a sector compared to others, it is a sector that naturally compounds. People do add more money. We have got more people reaching retirement age every year for the next decade than before. You just need to look at a population curve to see that. People need to save more for their retirement and look after themselves. I mean, the thing that actually really drives us is the sort of retirement gap and crisis that we sort of see in sort of unfolding before us. And that's what we want to make a difference about. I mean, the challenge and the real issue that we see is the UK has got to move from being a nation of savers to being a nation of investors, and it is not doing that anywhere near at the pace that it needs to. And in fact, when you compare the UK to other markets around the world, you compare the UK to the US or South Africa, where I came from, or other markets, those are nations of investors, actually, for different reasons. But predominantly, one of the reasons is that in the UK, there still is this mindset that someone else will take care of you. This mindset of, we've come from an era of defined benefit pensions, your employer would take care of you, the government will take care of you through a state pension and things like that. The reality is, the UK has moved on. There are no more people with defined benefit pensions. The generations retiring now are going to have very little. The generations in 10 years' time are going to have nothing. But I don't think the average consumer, the average client has actually clocked that yet, and that's a critical thing. It's our role to educate them. So what has to happen is people need to realize, actually, you need to look after yourself. We all know that the auto-enrollment contribution rates are way too low to reach a meaningful retirement, and they're not likely to go up by sort of government mandation anytime soon, given all the politics and things like that. But the reality is it's just simple economics. You know, if you know the details, which we will know, of how much people actually contributed, and between employer and employee, to defined benefit pension funds over the years, it has often been 20, 25, 30% of salary that was contributed to defined benefit pension funds. We're nowhere near that in DC land, and it's not going to get to that. People have got to realize that they've got to take responsibility, and that's our role to do. Now, you contrast with a country like the US, they don't have those state support systems. They haven't had a defined benefit pension environment for a very long time. There you've got to look after yourself. As a result, the taxi driver, equivalent in New York, would own stocks. But we don't have that here. And that is the problem that the UK needs to embrace and grapple with, and that is the role that we have to all play as an industry. That is why there's only 9% of people, well, the problem is exacerbated, I suppose, by the fact that only 9% of people are getting advice. Because when an advisor talks to a client, they do get them to the right place. But we've got the second problem is that because there's a shortage of advisors, because there are a whole lot of barriers to clients getting advice and all of those things, actually that number is far too low. And that number, with a sort of financial education and a sort of mistaken mindset that other people are going to look after you, is why we're sitting in this massive problem in this country. And, that's what we're trying to make a difference on. I think we've got some ideas and some things that we are working on, but it is a massive, massive problem that all of us in this room have got to make a difference about. And, I do say, also, I think it will be solved. The one scenario where it gets solved is that nothing happens for the next 10 years, and then people realize that, the people who are retiring 10 years ahead of them actually have had a pretty horrible existence, and then change happens. Now, that's not the scenario any of us want to see. We've got to start something before that, but you've got to break through in terms of messaging, financial education, and really starting to get access to more people, and that's what we're focused on.
Thank you, Stephen. I had a discussion with Michael earlier on whether I should call him Michael or Mike, and he said his wife calls him Mike and his mother calls him Michael. So, Michael, over to you.
Peter asked, how do you want our relationship?
I did, actually.
Thanks, Peter. If I start with a quick introduction and overview of AJ Bell, and then I'll talk a little bit about the market thereafter. So, as Peter said in his introduction, AJ Bell is a pure play platform provider. We do not provide financial advice. Now, there's a few nuances to that. We have our own investment management capabilities as well, so there are elements of vertical integration there, but financial advice is not something we provide. So I'll come back to that, but if I just give a quick overview of the business first. So the way that we've set the business up is to be a dual channel platform. So we operate in both the direct consumer market and then in the intermediated space through advisors, financial planners, wealth managers. We do that importantly with a single tech stack and a single operating model. So whilst the user interface and the distribution is completely different in those two different markets, once a client is using the platform, whether that's an advised client or somebody who's going direct, all of the data, all the transaction processing, it's all standardized in the back office, all dealt with in the same way. And the reason that that's important is it means that we genuinely do get the scale benefits of being in both of those markets. So we have well over 100 billion on the platform now, and that's one of the reasons that we're able to price at the level that we are, because the business is quite an efficient business in this market. We don't provide financial advice. You've mentioned Andy already, Peter, in your introduction. It was a view that Andy had about not wanting to overcomplicate the business, keep it capital light, keep it scalable, and stay out of areas where we did not believe that we would be excellent. I would add to that. I was agreed with that. I worked with Andy as his CFO and COO combined for 10 years, thereabouts, before taking over from him a few years ago. I was agreed with that view, but I would add to it that I don't want to be in competition with the people using the platform. Now, I say that not criticising that model. There are lots of firms who do that very successfully in the industry, and there are pros and cons to our approach. One of the, and I've talked about some of the positives as we see them there. Some of the negatives are you sometimes feel one step removed from that financial planning process. We're not doing that day in, day out ourselves, and so we have to make sure that we listen very carefully to the people who do use the platform, and that we take our business and our products in the right direction based on their experiences, whatever their business model might be. So pros and cons, not something that we have any inclination to change as we sit here today, but the market is consolidating, and so we need to make sure that we think about how those different business models emerge, and that we can be a successful partner to those firms and helping to support their businesses and grow the industry. In terms of the market more broadly, I think some of the demographics that fundamentally drive the growth opportunity that we see have been well covered. And I imagine legislation, regulation, and technology will come on to talk about in detail through all the different sessions today and later on in this panel. So I won't spend too long on them, but they are all areas that we have a keen focus on. On the direct side of the business, that is where I would highlight some, the changes in technology, I think, will actually play out more quickly there than they will in the advice side of the market. The route to market for somebody looking to go direct to consumers has already changed. Not the weight of where the business comes from. It's still a search engine game. It's still a digital marketing game. But we're seeing already the impact of the LLMs. About 18 months ago, we saw the inflection point of impressions continuing to accelerate and clicks not doing as the zero-click search results really took off. And so making sure that you can still reach the consumer in that world is an important trend. And also where the user interface sits between the LLM and between the product providers is something that will change, I believe. And I think that those trends are important for the audience here today, because that will inevitably have an impact across all aspects of financial services, even if there is an advice process as a key part of the service. Legislation I'll probably stay away from, because I tend to rant once I get onto that particular topic. Targeted support has been mentioned in a few conversations ahead of the session starting today. And again, I think probably more for the direct market, there is relevance there. And I do think that, at the lower end of the market, and when I say that, the average new customer that we're winning onto the direct platform has a portfolio value of around £30,000. At that sort of level, I think targeted support and fully digital journeys will be the way to give the best possible support to those customers. But as you then move through simplified advice and into full advice, there's still a whole lot of legislative change around pensions, as we know, and the tax treatment of pensions, and that's starting to accelerate the intergenerational wealth transfer. That will be, no surprise to anybody in the room. The last point I'll briefly mention is that one of the things that we've been trying to do is look at the ways that people can, even at the lower end of the market in terms of portfolio value, stay in a model of being given full financial advice. So Touch is a product that we've brought to market recently with that very much in mind. So orphan customers, as an example, intergenerational wealth transfer and supporting that through multi-generational families with a single advisor. That's one of the opportunities and one of the ways in which we see the market changing, and one of the things that we're trying to do to support the growth that's been talked about already in this conference. And I'll leave it there, Peter.
Thank you, Michael. Jerry.
Thanks, Peter. As you said in your introduction, I've spent most of my career in banking. So actually, whenever I joined the sector and looked at some of the things that we've talked about, this 9% penetration of advice into the population, there's a few things that I find completely fascinating about it. The first thing is, the cash that belongs to the some of the 9%, but all of the rest is definitely losing value every day. Those people are not getting the full benefit of the investment of that cash, and in a world full of volatility and uncertainty, they are clearly missing out. But somebody is benefiting from it, and that's the banks. It's going to provide some very nice low-cost liquidity and translates into very healthy bank margins. So, the debate is really about who should share in the benefit of this liquidity, and we strongly believe that it should be our clients to a greater extent. So you need to ask the question, if you're only penetrating 9% of the population, what is the barrier to people doing that? I think Stephen's touched upon some of those things. There's certainly perceptions around a lack of need, a lack of understanding around the utility of our products. I think the surveys have shown that there's a lack of perception of value around what we charge for our advice, and there's also a lack of trust in advisors. I almost immediately discount the trust one, because there's no shortage of mistrust of banks, but yet everybody has a bank account from the age of 11 or 12, and certainly everybody has one from their mid-teens. So people take bank accounts because there's utility in the product and they see a benefit from it, and it's widely accepted. So therefore, I think we've got a challenge as an industry for consumers to properly understand the benefit of what we bring in. If we don't engage consumers on their own terms to convince them of the benefit and the value of the advice that we provide, we are definitely failing them as a cohort. there are three broad areas in my mind as to what the industry needs to do in terms of helping close this advice gap, and they're to do with kind of advisors and advisor supply and efficiency. So supply of advice, I think demand for advice, which is this consumer element, and then the enablement of advice, which I think is technology. On the first of those, on supply of advice, look, it's clear that the advisor population has been gradually diminishing over the years. Advisors are retiring quicker than they're being replaced. And I think it's clear that we need more advisors, and we need to find a better way of attracting more into the industry. And we all have our own strategies as to how we build and grow and make our own contribution to that. But I think in addition to that, leveraging advisors just to make them higher impact and make sure that they can serve more customers at scale is a critical element of what needs to be done next. So the True Potential model from its inception has been about utilizing technology in order to be able to enable advisors to be much more efficient and to be able to scale their client portfolio. So take away the regulatory admin burden, take away the client admin burden, allow advisors to be able to do to serve more customers much more easily. And that was, the approach was historically, in particular, to find retiring advisors and onboard their clients so that we can ensure that those clients don't become orphaned. It's increasingly expanded into finding advisors who want to be able to grow their client bases and support them to be able to have the capacity to be able to do that. So that brings me to technology as the kind of the other enabler of advisors to be able to do more. Look, it's pretty clear that technology has changed the way in which we deliver advice. Again, certainly it's been the True Potential model from day one. But like Quilter, a vertically integrated platform where we've got advice, where we've got the platform, and we've got the investment solutions, all on a kind of bespoke integrated tech stack. And the philosophy behind that being, if you can reduce the friction, make it easier for the advisor, make it easier for the client, increase transparency for the client, increase customer satisfaction, and reduce cost, you can feed that back into being competitive, but also being a profitable business. So it's about extending the capability of the human expertise and not replacing it. And I think the next wave of where technology will take us in that is putting AI into all of those processes, whether operational advice or whatever it is, in order to be able to support the continuation of a human in the loop there, to be able to deliver more advice. And then the final part, which is this demand element, which is client demand. Again, very, very interesting as I come into the sector that we've managed to make financial advice somehow as a sector feel something which is exclusive. There isn't a perception that it's for everybody. It's quite complex, and there are perceived barriers to people receiving advice. So as a consequence, it's no wonder that kind of alternative approaches gain traction. Alternative things that are easier to understand, have lower barriers, and feel less complex. Cash is easy to understand. If you've got a bank account, it's easy to put money into a savings account. If you've ChatGPT is now easy to use. It's really easy to buy crypto. So it's no wonder you get these alternative approaches by clients emerging. I think we're also battling the Dunning-Kruger effect. I don't know if you're familiar with the Dunning-Kruger effect, which is this psychological phenomenon where people who have got kind of low skill in something actually perceive their skill to be much higher than it actually is. Applies to world leaders as well, actually. Certain world leaders, the ones with lower skill. So I think we need to find a way, therefore, to make the value that we add feel much more obvious And I think we need to move away from maybe some of the historical norms that we've had around exclusivity, complexity, and a focus on our products into actually tapping into what clients perceive that they need, which is certainty, less stress. It's about us. We need to be able to explain, how am I going to make your life better with the advice that we provide, and why is that going to be really good value for you in order for them to get over that. Again, the True Potential focus, that the founders of the business built in from the start was to make it really easy to invest with us, to have no minimum threshold for investment, so you can start small, to have intuitive digital products that were, again, easy to engage with. We're 24/7 available, and I think banking has its own parallels there in the rise of the neobanks, who completely disrupted the banking industry by just finding ways to just make things easier to do, lower barriers to opening accounts, just make it all very simple. And then we also have this hybrid model of digital and human advice, where it's really easy to get an advisor. You can see an advisor on screen the next day. You don't have to go to their office. You don't have to chase them off the golf course. You don't have to wait till they come back from Marbella in order to make sure that clients can feel like it's really easy to engage with. Because I feel like we've got, there is genuinely, as well as a commercial purpose to what all of us are doing. I think there's a real social purpose, because that attrition of the value of our clients' money is real, and again, as Stephen said, will in the future come back to haunt them.
Thank you very much. Thank you. So, a couple of observations from me, and then it's your turn. So, what you can see, one of the things that I learned, you learn something every year. You do these things. One of the things that you learn is that to be a CEO of a business, a substantial business and a growing business in the UK, you have to think more about the type of business that you're in rather than just the business that you run. And what you can see from those answers there, or those introductions there, is each of the individuals on this panel, I'm sure some of the other CEOs in the room, think deeply about what problems they're trying to solve and how their business can be orientated towards solving those problems. And you can see and you can feel, or I can feel, a passion around these guys being able to solve what is an admitted and obvious problem. 8%, 9%, whatever the number is, of people saving is just not enough. You get in a taxi driver in Australia, right, and on the assumption that he or she is over the age of 18 and in work, they will have a risk-based investment, because superannuation demands that you do. You do the same in New York and other places. We're just not, and the point of exclusivity that Jerry so articulately demonstrates is right. We create an impression through the language that we use, from the way that we behave, from the way that we say we've got to do hard exams and all that sort of stuff, right? We create an impression that we are an exclusive group, and we're not. Right? We are here genuinely to help and grow. The second observation was the word I heard most in 4 of the 5 speakers was barriers. Right? So not only do we make things difficult because of the vernacular that we use, but also the barriers that are presented to us are unprecedented. I mean, you'll see quite a lot of people move from the banking environment to our environment because it's a regulated environment, but there are still those regulatory, you talked about it, Michael, the regulatory, well, you didn't talk about the legislative one, thankfully, but you talked about the regulatory, the legislative, and the technology barriers to entry. And they are substantial and they are significant. And we need to find a way of trying to help to unlock those. And the work these guys do outside of their businesses in the representative bodies that are advocates for change is immense. You don't see how much time these people spend, and typical CEOs spend, outside advocating for change. Right, enough of me. Right, it's over to you. Hopefully this will work. Otherwise, what I'll do is what I always do, which is pick on someone. Right? And the people I pick on generally are the same, so they know what's coming. I'm supposed to throw this ball, right? I've done my back in, and I'm not very accurate, and also I can't see past about the third row. So, hey. Oh, Ben, go on, then you go. That's an easy one. It's even the person closest to me, right? I can't even get that right. So what chance? Go on, Ben.
Thank you. So thank you, panel. Fascinating. Question from Michael. Really interesting to hear that you're getting a lot of traffic. I might even read the majority of traffic from chatbots now. You talked a little about the interface potentially changing between the chatbot and the platform. Can you talk any more about that? Did you have in mind agents? How do you see this evolving?
So first of all, to be clear about the route to market point, we are not seeing the majority of new business or flow come through the LLMs, but we've seen the impact that they're having on consumer behaviour, on how people are researching, on how people are going through that process of buying a product. It's still, at present, it's all about Google. It's still SEO, it's still PPC, but you can see that it's changing quite rapidly. So it's more that the rules of engagement now are understood, the importance of being in those search results, and then thinking about how do you actually get the client to go through that journey if it's not a case of having to click on a link to consume your content. The other point I think is now the more interesting one, which is around the user interface. And you've seen in other industries people starting to experiment with this. So if the consumer is interacting with the LLM, researching, asking questions, considering purchase, to what extent do you then start trying to push your product into that environment? So through model context protocol, MCP connectors are now starting to be built. You can take literally elements of your user interface and serve them within the LLM. That's really interesting. Now at present it's incredibly niche. You know, there's not a general awareness of that amongst the consumer. It's tech enthusiasts who will be who are playing with these sorts of capabilities where they exist. It's a good way from being mass market, but you can see that I don't think, in the way that the user interface for a business like ours has changed. When Andy and Nicholas set the business up, it was face-to-face conversations, it was telephone calls, it was checks. That was how the consumer interacted with the product. You then go through the internet, you go through mobile. The user interface changes all the time. I do think that LLMs will change that customer behaviour. Like I said earlier, I think you'll see that in the direct space before you'll see it in the world of wealth management and advice. And I'm not saying that that's to the detriment of business models or even existing ways of interfacing with customers, but I don't think it's as simple. It's a far quicker route to market to build a set of MCP connectors and serve your user interface within the LLM than it is to, we've done this as well, but to build a Gen AI platform, and then we've got an API layer, and we then call in all of the operational and product teams, those different APIs, to get that same kind of functionality. So you could have that same kind of conversation with the consumer in the front end of your product itself. But then you're into an interesting regulatory question about what interactions you've had with them, where the responsibility lies for that, what regulatory permissions you've done that under. But if they're having that conversation, as they are doing today, directly with the LLM, and then you're just serving aspects of your user interface into that environment, there's actually quite a different regulatory position there, because you don't see the conversation. All you see is the transaction off the back of it. So definitely an area that will evolve rapidly in the industry. As I said, direct first, and then we'll come over to the world of wealth management.
Thank you, Michael. I'm not going to direct each of the questions to all of the panel, because otherwise it won't give everybody the opportunity to express in their own areas of interest. But one of the things that does, as kind of your question, Ben, to Stephen, you bought NextWealth relatively recently, rebranded it. That's a new area for the group. The Does what Ben says about access resonate with you? Is it, and what's the rationale for buying it?
Yeah, so we bought a little business. We now call it Quilter Invest. Our focus on that was to start helping advisors deal with smaller clients, to create a digital journey and experience for advisors. I mean, we've got a lot of advisors who tell us they have a client who comes into their offices who's got £30,000, £50,000 to invest, and in the politest possible way, they try to tell that client to please go away because they've only got space for 150 clients, and it's perfectly rational to take people at age 50, 55 at peak wealth, etc. What they want from us and what we've built for them is an incubation model. So what they will now be able to do is to say, well, hopefully they'll say, there's this great proposition from Quilter, we've checked it all out, it all stacks up. I'll send you a referral code to it, download the app, get started there. And they will be able to get the clients to take their first steps. There will be a targeted support journey that will allow them to pick a fund, etc., and things like that. And the advisor will stay in touch with those clients. They'll be able to communicate with those clients a few times a year. We'll recommend they sort of keep in touch, tax year end, budget changes, those sorts of things. They can see what the clients are doing. And if the client wants help, they can press a button and they go back to those advisors. And we'll always keep those clients as clients of those advisors. So what we're looking to do is we're looking to create for advisors and for ourselves the next generation of advised clients. So sort of almost 5 or 10 years before they need advice, to get them in and to start building them up in a supportive environment. We actually don't see clients as advised or non-advised. I think in the future, we see clients drifting in and out, doing both. I mean, already we see some clients who have some money that they have their advisor looking after and other money that they want to look after themselves. And I think that's going to continue. And I think that the future advice models will also not necessarily always be ongoing service every year. There may be different models. So we're gearing up for that, and that's what we're looking to do with this business. It's effectively our way to get into the targeted support space.
Okay. The next question is directed to a particular individual for three reasons. One, she asked. Secondly, she tolerates me as the chairman. And thirdly, she's very handy for the microphone. There you go.
Great, I can throw it after. So my question is about verticals. Robinhood, a US trading platform, launched a pension. It's not a SIP in the US. Launched a pension, and they've applied for the banking license. And the reason that they did that was because every time they add a tangential service to their offering, they attract more clients and they get a larger share of wallet from the clients that they're servicing. And we've seen Revolut in the UK offer a trading platform. And I'm just wondering and I don't know, Jerry, if it makes sense to come to you with a background in banking, but does it make sense for us to think beyond wealth as we try and grow our sector? Because will we grow by reaching more people, by offering more services and becoming the financial services provider to our clients rather than the wealth manager to our clients?
Direct that initially at Jerry, but then just as a warning, I'll take it to you as well as Andrea, because you're trying to think about other ways of building your business. Jerry.
So look, banking is a massively consolidated scale game at the minute. So I think the notion that those of us who are in wealth would look to diversify into banking, I think is really quite a challenge. And it's certainly post global financial crisis, other than the brief advent of challenger banks, we've quickly seen scale becoming the primary concern of banks. On the other hand, if you take it in the other direction, you can see with NatWest's acquisition of Evelyn, you can see with larger banks' interest in the sector being really quite transparent, and investment bankers are a very chatty bunch, and they'll tell you about exactly who's interested in exactly what. And you can see with private equity participation in our industry that look. Clearly, there's a direction of travel there. It makes perfect sense strategically for a large bank who sees money disappearing from their clients' deposit accounts into investment products. for them to want to retain some of that. Clearly, they also need to diversify into more fee-generating products. I think the economics of it, given the multiples that the sector trades on versus where banking has been for the last 2 decades, have been really challenging. But again, you can see, and hopefully it'll be evidenced by NatWest, kind of recovering from the slight telling off it got from the market on the Evelyn pricing. Then I think it's probably a trend which is going to continue.
So Andrea, you're diversifying your business with the acquisitions that you've made. And are there any plans, or do you think there is any merit in further diversification along the lines that Heather talks of?
To Heather's point of vertical integration, the insurers have done that for a long time. I think Standard Life was probably one of the first to try and integrate some financial planners, 1825, etc. But some of these, some very focused strategic initiatives that worked well for their day. But I think building on Stephen's point, the end client is critical in all of our strategies. And I do wonder whether the end client wants to put all of their assets in under one name. And I think we're all, certainly our view of the future would be partnerships across the industry will serve us well, and that's what we are beginning to think about. Clearly committed to independent financial planning, which is why we've bought and now integrated 6 businesses, but ultimately we truly believe in that independent financial advice. We work with IFAs up and down the UK, they're not competing, and ultimately the integration in that value chain, it has to benefit the end client as well as the balance sheet of the corporate. And the banks, they're all interested, clearly. NatWest made a very big acquisition. From a strategic model, cash models are very important to every bank across every bank across the UK, and more broadly, I do wonder about how the regulator will handle deposit targets for their financial planners, because we all know they're out there. But that's not my problem. We're still independent, still firmly on the UK market, because that's where we believe we've got the capital base to grow. But it's something that's here to stay, but I would love to see us working through partnerships further to benefit the end client, get the price down, get the service up, and get much more efficient as we build out.
Yeah, it's interesting, isn't it? I think there's a general belief that vertical integration serves primarily the people who do the vertical integration. I don't think that's true. I never have. I think that at the essence of a client's decision is clients like choice, but they don't like to choose. So somebody can choose on their behalf, right? Then and their trusted advisor, they value that. So I think you can, and many people do, deliver good quality thing through the vertical integration. But having partnerships is really interesting. So, I mean, clearly some of them are up there, right? And they're big, and they bring things that we can't necessarily build ourselves. Okay. Right. Yeah. I will lean across gracefully. Well, not gracefully.
Hello everyone, my name is Shivan. I'm representing Urban Synergy today. So I wanted to touch up on the aspect when you said that only 9% of people actually take financial advice, and what Mr. Levin had said about people being more savers than investors. Do you think that's more of an educational issue? Because personally, being a 17-year-old, I haven't really seen financial advisory targeting me or anyone around my age, especially when we exit uni and have so much financial debt. Then I kind of want that advice, but I don't really get it. So do you think it's an educational issue in school, or do you think it's kind of that you don't target our age demographic? Because then we can go and take on financial advisory later on as well.
Thank you. Don't you just admire somebody at the age of 17 to have the courage to speak in the audience?
So I think financial education is a huge thing. And that actually is where this does need to start. I mean, we're a big advocate of that. We have a foundation, and the focus of our foundation is actually financial literacy and financial education. Actually at all ages, because There's a big gap, obviously, in the school curriculum, and that is starting to be addressed. There's talk about adding financial literacy to the school curriculum, but I think that cog's turn slowly, so I don't know how many years that will take before that's actually in. But actually, there are people, young adults, that have never had financial education, and so financial literacy is a problem sort of the whole way through, and it is about the critical concept that I don't think people really understand is inflation and real returns, and they're not concepts that are anyone's fault for not understanding. You've got to be taught these things, and the time value of money, realizing that money sitting in a bank account. I mean, a lot of customers got very excited when they could get a 5% sort of interest rate on a bank account, and thought that was a great place to be, but it's still less than inflation was at the time, and they were getting a negative real return. They're going to have less purchasing power. And the stats, I mean, Rachel Reeves has actually come out and even quoted some of these stats, but we're putting out stats now as the industry showing if you'd invested £1,000 at 10 years ago, what it would be worth in real terms now, versus what if you'd put that £1,000 into the S&P or into the FTSE or into any stock market index, and the numbers are striking. I mean, you end up with your £1,000 is worth 900 after 10 years. If you, in real terms, if you put it in cash, it'll be worth most time periods about close to £2,000 if it's actually been invested for 10 years in the S&P, for example. That order of magnitude, those are what the numbers typically come out at. It's a phenomenal delta, but the average person doesn't understand that. So there is a massive financial education role. I mean, I am frustrated as hell that financial education is not taught, or financial literacy is not taught in schools. I really think it does need to be, because that's where the difference starts. And obviously, look, at people at a 17-year-old and someone coming out of university will not have a lot of money to invest. But the other thing that people may not realize is, there's other famous stuff that a simple graph and a simple little illustration of compound interest will show you, is that if someone saves for 10 years a monthly amount of money, even if it is £20 a month, and then stops after 10 years and just keeps that money until they retire, they will always have more money than the person who starts 10 years later and saves for 30 years until they retire, as an example, that same amount of money every month. The power of compounding, and especially that early start, is you just can't beat it. And things like that, when people understand that, so if you can get a university student or someone in a first job just to put a little bit of money aside, compounding power is phenomenal. That is not an understood concept in this country.
Thank you, Stephen.
There you
Stuart,
go.
you speak to people day in, or you and your team speak to real investors day in and day out. How hard is it to get the younger people interested?
Yeah, look, I think I would concur that point. It's not just the young people who don't. I would say probably the younger people are more financially literate than the middle-aged and slightly older, because I think at that point people become terrified of then learning. That graph, I was at an event actually, the Octopus, we were talking about exactly that. If you invest in that first 10 years and then stop, compared, but it's a widely unknown phenomenon, that compounding issue. And I think that's a bigger part. I think in terms of the audience that we talk to, they're normally people who don't have the education and therefore are asking for an answer to their financial planning question, or they need to get to a solution. I think the big barrier, and I don't know the statistics, other people around the room will know it far better than me, but when RDR came in and we made advice actually less expensive but just more transparent, everybody bucked out. The issue is complexity and culture. You go to the States, if you've got friends who are American, they will all tell you what their return on capital was last year. They sort of know what that is, and there's a base level of understanding. I think talking to our friends, even my colleagues, my PA would be a good example. We've just had an event. Kirsty will make some money. She went home and asked her dad, who works on a building site, for financial advice rather than the business. And we challenge that. I think the natural lack of education in the UK does suppress saving, and also the fear that all investment comes with risk. you know, we could all, and probably our children could talk about the risk warnings associated with investments. I think that's the bit we need to flip on the head. My taxi driver said Bitcoin, by the way, was the thing to get into this morning. But it's that usual, the one last night was suggesting antique watches. But you've got people doing side hustles or trading or, you know, influencers on TikTok, whatever they call those guys. But I think we have to simplify the world, but then also demystify the risk so people aren't silly. They are able to take risk, and we should encourage it.
Okay, thank you, Stuart. Michael.
We're all being too polite, so I thought I'd get a bit of disagreement.
Yeah, good.
No, look, what the guys have said, a lot of sense in that, but it's just an additional view. So on the financial literacy point, this always frustrates me because it's been studied it's been studied properly in America. And one of the issues with going and saying, right, we have to put this on the curriculum, we have to do this in schools. And by the way, there's no harm in that. My wife's a teacher. Some of the things that get taught in schools, we can afford to replace some of those things with financial literacy. That's fine. But in terms of solving the problem that we're talking about, the point between the intervention, the provision of the education, and application is so vast that it's been proven, various meta-studies have proven, that the impact is virtually zero. So it's not an effective solution. It's things like targeted support. It's things like getting the unit cost down of providing the services that people in this room provide through some of the technologies that we've talked about. That is actually a far more effective solution. Yeah. As for the original question about a 17-year-old and the financial challenges that you're faced with at that point and advice, I'll let these guys decide on the commercial merits of being able to serve a customer in that situation, because that's the challenge that exists as we sit here today.
It is.
Michael. I'll use your Sunday name, Michael. the converse opinion to that, and we sort of is the language used, but actually what a 17-year-old probably needs is a plan. And then we can leave you alone and off you go. You'll know what that plan is. And I think the advice isn't designed for that. It's designed for that dripping roast of annual servicing. You know, you were talking about actually changing that model a bit, but I think that's partly the barrier. Now, guided advice, guide a plan, life plan, off you go, and then you can self-service, you can accumulate, and then when your circumstances change, then you can then tick back into the system. Because the price to serve, however low you make it, that's never going to be personalised. It has to be commoditized. You have to be able to self-serve, I think, for the vast majority of times. And most people don't need to see someone every single year to do that sort of stuff. So I'd change the language and say, make planning at the beginning, the education piece, and then worry about the taking risk.
Very good. Thank you. Okay. I can't see. Were you waving at me, Emma, or? Oh, right. Well, I'm not even going to attempt it. Just go, right? I can't walk. Oh, see what chairmen have to do when the CEO says. Oh, thank you for meeting me halfway.
Apologies for the exertion I caused. At the risk of opening the rant that you talked about, Michael, obviously it's been a lot of legislative instability in the last couple of years, I think more so than many of us remember. I'm just keen to know what all of you are thinking in terms of your businesses about how they could react to potential legislative changes that could come down the line in the next year, 2 years, and what assumptions, if any, you're baking into your business plans.
Okay, thank you. Bearing in mind we only have 9 minutes left, Michael. Right.
Get somebody else to answer.
Go for it.
Look, I'll keep it very, very narrow. In terms of the amount of legislative change and the substance behind it, so pensions and ISAs, obviously what we focus on as a platform provider, and there's been plenty of change there. The thing around applying IHT to unused pensions on death that concerns me is the lack of thought about how that's actually going to be implemented, what that means for people who are in that unfortunate position of trying to execute the instructions of a will. It'll be an incredibly difficult process that will put lots of strain on different parts of the financial services and legal system that just are not designed to deal with it. To be a personal representative in that situation when those rules come in April 2027, I think will be an incredibly difficult position to be in. It's the lack of thought and engagement with industry. It's been driven by an ideology to say we want to do this, we'll just then find a way through the process. I'll steer clear of ISAs because I will blow the time limit. The other thing that I will add is the way that the budgets have been run over the last few years has actually done more damage than the contents of the budgets themselves.
Yeah.
So the long, drawn-out period of speculation and uncertainty leading up to those key fiscal events has actually been...
Tell you before the budget, so it's not...
No, yeah. Only recently, yeah. Okay.
Yeah, that 2 or 3 months of speculate, test a few ideas, and then you, as you say, land on an answer and leak that just as the Chancellor's about to stand up and give us her rehearsed speech. That would be the one. That's the one thing that has frustrated me more than anything else, and that is entirely avoidable. That's a choice about how you go about a process. There you go. I'll stop myself.
Sadly so. Yeah. So Jerry, you've experienced legislation from a different aspect, and they would say banks are over-legislated, over-regulated. What does it feel like on this side of the fence?
So that's a really interesting question because this sector feels very different in terms of its degree of fragmentation or collaboration versus the banking sector. So I'm still trying to get my head around whether or not it's just how we perceive each other or whether or not there's fundamental different competitive strategies at play. So in banking, most banks have got pretty much the same business model. Okay, there are different nuances to it, but pretty much every bit of legislation affects every bank in the same way, which means as a consequence, banks generally find regulation a non-competitive topic. And therefore, you can present a united face of the sector to engage constructively with the regulator to try to encourage them in a particular direction, which is conducive to the economy, to clients, to the sector. I don't perceive we've got quite the same joined-up approach in this industry. Some of that, I think, is down to the fact that, well, you've got 5 people here with 5 quite different business models, and all of whom will be affected slightly differently by changes to regulation. Some of it, I think, there's just historical competitive tensions in the industry, which might be to do with personalities and might be to do with other baggage. But I think we can do a better job of finding common ground to make sure that we present a case for coherent, constructive management of regulation and legislation, which will be in the nation's best interests, not just in pure selfish interest.
Very good, excellent point. In a splendid example of audience collaboration, the microphone has found itself automatically to our next question.
Thanks. So, not wanting to open Pandora's box given the time and the coffee. In most industries, if you're trying to grow, it's about marketing, it's about advertising. Our industry is really quite poor about getting itself out there, turning up on, social media streams, all of this sort of world. And apart from maybe Fisher Investments, who seem to be bombarding all of us, point proven, we are really, what is holding back the ability to really go big and start promoting? Because if I look at places like Australia, one of the reasons why there is so much talk about investments is because they are competing, they're stealing clients off each other on a sort of monthly basis, and therefore people are starting to understand the products and understanding the difference between different vendors, providers. We're not really doing the same thing.
Okay.
Discussed.
Whilst it's a perfect opportunity for you to talk about your TV and social media and all the stuff that's going on at the moment, the brand awareness thing, can I just ask Andrea first,
Sure.
where you think marketing comes in and why, to the questioner's proposition, we're not getting out there enough?
Yeah, I love the question. My observation is very similar to yours, that we are very modest about the returns that we deliver for our clients, and that's a cultural piece. It's I think it's a wider sector piece as well. So there's a huge opportunity as part of the education to get out there more in front of clients. I've actually brought someone in from telecoms, from Vodafone, and it's incredible what she's done already on social media, but with a relatively small budget, you can make a very big impact. Again, we've gone down the sponsorship route because it's really important for us to put our brand against a brand that we trust and that we've got joint values, but that seems to be landing. I'm not sure it's landing with 17-year-olds yet, but certainly more people of my age have commented on it. But that's where we're putting our investment. But we do, as a whole, probably need to join up more. Jerry, I think there's the sector is large enough for us all to do very well, and to resolve some of these challenges, it's probably an opportunity for at least the people on the panel to sit down and have a chat about how we can resolve some of them. But marketing is our responsibility to get out there more, and it's not about praising our own business, it's about helping the UK as a whole in the economy. But I would love to somehow influence the news and the media within that, and that's a whole different ballgame. But the way, all of us, I don't know about you, but the headlines every morning, I think, right, I might just have to skip them this morning because, the Americans don't seem to realise what's going on. My brother-in-law's there, and they don't talk about it day in, day out in the doom and gloom way that we do. He finds it quite perplexing, being a very grim, gruff Glaswegian, but he's surrounded by very positive views of their economy, their approach, etc. We've lost that somehow. And I think we should be all very proud of what the sector we work in, the clients that we're trying to support and serve. And I don't have the answer of how we influence the media, but I'd love to find a way in.
So I spent some time as an advisor in many decades ago. And the one thing that always lived with me was when I had the privilege to go into a house that had been bereaved, I took something in. Everybody else took something out. Right? And so that ability to make a difference to people's lives is something that we underestimate, and we should be very proud of what we do. And you can see from what AJ Bell are doing in terms of advertising, what Stephen's doing in terms of advertising, getting people from saver to investors. We are getting out there, right? But we're not getting out there enough to show the value that we add. Okay. Thank you for making my job easier. Thank you to the panel for being such a great panel, and show your appreciation.